So, good evening, everyone, and thank you very much for joining for another session of Market Pe Charcha by Helios Mutual Fund. With me, I have Dinshaw, Irani Dinshaw is our MD and CEO, and we will be today again discussing about the recent happenings in the market environment, and then also be taking questions. So I would encourage participants to type in the questions in the Q&A box which is there, and towards the end we will be taking these questions. So to begin with, Dinshaw, we have we've been having a very comfortable macro kind of an environment, right? Liquidity, rate regime change, and so on and so forth. But where do you see, on a future basis, where do you see the value emerging from the market? Where do we see, the returns coming from, or sort of, investors making money, and how are we positioned, to benefit from that in our portfolios?
Well, thank you, Devi. Thank you for the question, and thank you for this webinar. So let me start off by, at least even before that, the overhang in the market. The two major overhangs which started off with the trade wars, which was in April 2nd April 25 is when Trump started off the first of his trade wars and escalated further with China. And the second one obviously was the Pahalgam attacks, which was a major overhang, and we were expecting some reaction coming through by the Indian government, and which did come back in a very heavy way, and quite deservedly so. That was needed also. So anyway, so let's start off with both of these. Fortunately, the Pahalgam attacks, the reaction of our government was pretty stern, which was needed for the time it was. And fortunately, again, the opposition, the Pakistanis, didn't react to that. They, in fact, started making excuses and stuff, which was a very good thing, because we served our purpose. We did do a lot of damage to whatever we wanted to do, and came out unscathed. So that was one big positive for not only India, but also for the markets. Secondly, on the tariff wars, if you guys remember the last time when we, immediately after the tariff war started, we had done this call, and I'd said the biggest issue will be China and US settlement. Looks like that is what is working out, right? Already China and US have come down. China has reduced the tariffs from 125 to 10% on US imports, and US on its path has reduced it from 140 odd percent to 30 odd percent. And that also, they've said that 20 is because of fentanyl that was getting imported from China. I'm sure China will get back and saying, look, we have taken these steps and stuff like that, and that 20 also will. So it'll be a 10% kind of duty on from both the sides. There's a 90-day reprieve which has come through, and I think things will work out. The whole purpose of this tariff was, I think, to get people on the negotiation table by the US and negotiate separate trade deals with them. Already UK has done it, right? There's not much of a change from what you had done. They've been allowed to import into US on a quota basis. I'm sure that also will go away at some point in time. But the quotas are big enough for not to harm any of the existing exports that are happening out of UK. So I don't think that it's a rehash of the old deal which has happened. So there's not much change here, right? Only thing that has changed is a 10% across the board duty on all imports into the US. So that's one. Again, as I said, that in the case of India, again, there's a duty being worked out. I'm sure it'll work out at 10% odd kind of duty, which will be applied by US as such. Yeah. So basically now, India and China are going to be at par. Our bullishness earlier was that US will come down heavily on China, and as a result, India will benefit because there will be a duty differential in favor of India. Seems like it's not working out. Okay, so if both are at par, that's not good news for us. It's not bad news either, but it's not good news for us because we are back to the same old way that we were working. Obviously, there'll be curbs on how much you can import into US from China and stuff like that. So India may benefit to that extent. Already you heard yesterday Donald Trump belittling Apple, saying that I've told Tim Cook that he has to cut off production in India, he has to bring production back to US and stuff like that. So things are not working that much in favor of India. So mainly, I think all the export-driven plays that we are very bullish on, I don't think that's going to work. Not we, as in the markets are bullish on. By the way, we took a very proactive call way back in March itself when we knew that the tariff war was on, and we moved out of most of the US-facing products, companies, and basically moved into the domestic demand-driven companies. That's how we change our portfolio to effect that, right? So that was on this scale. But let's understand also why US is doing this, right? So basically, US has owes the world $62 trillion. Owes the world as in the world is holding debt worth $62 trillion in US denominations, right? And US in turn owns local debt of around $34 trillion. Sorry. So there's a net, and it's called NIP actually, NIP, which is net international investment position for US is a negative $28 trillion, right? Now, when US does this deal, so basically what happens is if you are a currency of reserve, you need to run a healthy deficit in your books, right? Because you are making the market for your currency. That's how you're the biggest lender, you're the biggest borrower. That's how it works in the world, right? And that's why reserve currencies are the way they are. When UK lost that, pound lost that in the early 1900s, it was the turn of the USD to take over that slack, and that's how they worked, right? So anyway, if you are working these deals on the way this is, right, basically you're trying to get import parity. So basically you will not be making market for your for your currency. So in a short span, the currency will depreciate. Normally this happens when the country runs a very big deficit, which is the case with the US. Right? It happened in 71 and it again happened in 85. This is, I'm talking about history, when US had to desperately get their currency in shape and stuff. If you remember, 71 was when they shifted from gold to basically dollar float and stuff like that, from gold based currency to dollar float. So that's what they did, and saw the currency depreciating. How that helps is that since they're a currency of reserve, the holding that they have, the foreign holdings that they have, which is around $34 trillion that they're holding in their books, that gets repriced because the dollar is depreciating. So basically that will go up to whatever extent the depreciation happens, right? However, interestingly, the dollar debt that the world is holding will not change. It will remain constant. So effectively that NIP, which today is $28 trillion, will reduce to anywhere between, say, $20 to $22 trillion. So effectively, by purely depreciating the currency, they've compressed the NIP to that extent. So that's the beauty of a reserve currency. And I think he's done a perfect job here, right? I mean, one already saw that our rupee, which was at 88, literally has come back to 85. In fact, it went down to as low as 83.50 and again came back to 85 as such, and has remained steady out there. So it's a perfect way to play this and reduce your what you owe to the world so effectively. So that way, and that only that country can do it, right? So he's done a perfect job, and I think that will help the US in the longer term. There'll be hiccups in the short term because anyway, US is seeing some hiccups already in terms of the economic growth, right? Why I'm talking about US, and I'll talk about China also after that, because these two are combined almost, say, 50%, 40% of the world trade, right? 40-45% of the world trade. Now, if these two guys, world GDP rather, if these two guys are having problems, there is problems globally, right? So that's what's going to happen in the US. US will see a slowdown. Hopefully, it won't be a recession. They'll see a slowdown. Already, they're seeing that. Last 2 quarters, they've seen the GDP growth falling off. Unfortunately, because Trump is talking about domestic production, the employment hasn't come off. Employment, if anything, has been going up, right? And as a result, the concern that the Fed has today is of a stagflation, which is high inflation and no growth, which is the worst the economy can face. Hopefully, I think US is too smart to do that. I think they'll come out stronger of this. So maybe that's what will happen. As I said, 71 and 85 are the 2 years when they did this kind of a play and worked out perfectly for them. Going forward, after that, they came out stronger, right? So that will work out. China, unfortunately, is seeing a lot of problems. Already, they had problems of their own, domestic problems, unemployment running amok, demand not picking up, despite the economy doing so well on the technology front. Unfortunately, the technology is what has led to unemployment in China, because they run these dark factories where there's no workers. There's only, in fact, recently Xiaomi inaugurated a factory which produces 1 mobile phone every second without a single worker inside. It's a very compressed kind of a factory. It's like just throwing out mobile phones. Okay, so that's what it is all about. Yeah. So China will continue to see problems. So now we're talking about 40% of the world GDP having problems, right? So that's where the concern is on the global side. Fortunately hopefully, not fortunately, hopefully, US will come out of it unscathed, probably another couple of quarters. Okay. Now let's come to the domestic markets as such. I don't have much good news today, but let me just give you one data point. September of 24 was when the Indian markets had peaked last, right? And now they peaked again, by the way. September of 24, the MSCI India index, Morgan Stanley Composite Index for India, hit a peak valuation of 24x forward earnings, 24 times forward earnings. Today, that earning is 23 times forward earnings. We had 1.5 standard deviations away from the mean earnings that we've been quoting at, which is roughly around 20 odd times, 21 times forward earnings, right? Not good news. Again, we are very close to the top, somewhere close to the top. However, within this 23 times, there are pockets. There are pockets because obviously the whole market is not at 23 times. There are certain stocks or sectors which are looking much more healthier than the overall market as such. By the way, the earnings growth for this particular quarter, which we had already called out, we had called out a mid-single digit kind of earnings growth. So the number of stocks which are reported thus far have come up with a figure of some 3% or 4% of earnings growth, which is according to us in line with what we had estimated. The disappointments are far greater than the ones which have met the expectations or are above expectations. I think the ratio is almost for every 3 stocks, 10 stocks, 3 have disappointed and 2 have either met their targets or just beaten the targets. Yeah. So that's how we stand today. And fundamentally, as I said, it's not looking as very supportive. But once again, let me just refresh some memories because what we did was we said that if this tariff war is out of the way, we may see a party coming back again sometime in the December quarter. And the whole basis of our saying that was that the growth rates will start picking up sometime in the September quarter. And that's when December will start looking very good for us. So that's how we stand today. How we've changed our portfolio, according to this, is, as I said, that we've basically started looking at stocks, or rather started putting up on stocks which we believe are more of our country focused stocks, right? Which are based on our feeling of our country. So basically, we're making our portfolio airtight for the future. Yeah. Whatever happens in the global economy, we're not bothered. We're looking at domestic. So basically, what we've done is financials, the BFSI, which we've been very bullish on. We were, if anything, strengthened that position there, almost 43, 44% in that particular segment per se. Then coming to the hospitality sector, that's another one that we like. Again, fairly bullish on that segment. Healthcare, mainly domestic facing pharma, as well as the hospital part, and one or two diagnostic stocks which we like. We've been adding up to those as such. Consumption, again, we've been very different from the rest. We don't like FMCG. We don't like durables much, but we like the platform guys, which we've been ramping up on. And that's what we've been doing as such. So this is how we're holding our own as such.
So then should investors, what are we suggesting now? We've been telling investors that okay, when we launched mid cap and all, we were recommending investors that they should be looking at SIPs and STPs and all that, because I think in mid cap at that point of time that made sense. But what are we making now? I think should they be doing SIPs or lump sum also makes sense now? Which pocket of the which is like whether they should be doing it in flexi caps or they should, it's time to again do lump sum in mid caps. What do you think about that?
So Devi, I have no doubt in my mind that of all this hassle which the world is going through or whatever's happening, India will come out much more stronger out of this as such. And why I'm saying that is that you'll seldom come across an economy the size of India which will grow at that pace as such. And that pace will be driven not by exports, not by PLIs, not by China plus one, but by domestic consumption. Our consumption has been suffering for the last 2 years. So there's a pent-up kind of consumption which is just waiting to hit the markets, right? And I think the government has realized that, and as a result, one saw that huge SOP which came about in the budget by way of giving the tax breaks to the consumers. Secondly, RBI also is, I think, cognizant of the fact that you need to put some fuel into this fire of consumption. And the fuel basically is the liquidity in the system, which the earlier governor was very keen to suck out because of inflationary issues. But the present governor is fairly clear that he needs to infuse liquidity because inflation is very much in command, because the base is anyway becoming larger per se. And that's why that infusion of liquidity is happening on a regular basis by the government. In fact, we're running a surplus liquidity of around 1 lakh crores, which is a very healthy sign in the banking sector. And that helps in consumption. So I think these two factors alone are enough to drive our economy. Having said that, that's why I said that within the pockets that you see. So basically, what are we avoiding? We are avoiding IT stocks. Totally depend on the US. Our call is US is going to slow down. If US is going to slow down, IT is going to slow down. Discretion is there. So basically, just zero IT, right? Literally zero, because we have just one stock in IT, and that's mainly to do with auto space rather than IT space, though it's a IT company, but it deals with autos, right? So that's how we are dealing with that. Secondly, we have zero FMCG, because FMCG per se, by the way, if you earn more, doesn't mean that you will take a bath much more often than what you do. Right? You'll probably wear new clothes, you'll buy a new house, you'll buy a new car, and maybe these big ticket items you'll go on mortgage, you'll take a loan and do that, right? So that's why we have these discretionary guys plus the financing guys. So that's how we play it. So avoid the consumer staples business per se and going for the discretionary business. So that's how we're playing this. We avoiding all companies which are to do with PLI. We avoiding all companies where we believe the valuations are far too stretched as compared to what the historic valuations were or what the industry valuations were, right? And it's worked out perfectly, because if you see the quarterly numbers which are coming out, if anything, it's helped establish our thesis that these are the companies to avoid and these are the companies to buy. So that's how it's working out. So that's how we want to play it. Having said that, obviously, I leave it to the investors to decide how they want to come in, but it's always better to have a game plan in mind. As I said, that probably by the December quarter, which is starting probably October, November, December, one will start seeing things coming back. So maybe you can plan out a STP which is spread over 3-4 months, and then probably partake in the whole rally when it comes about. SIP obviously is a different animal altogether. SIP, I don't think anybody should do away with the SIPs, because this is the time when you can really average out, work on this. And by the way, I don't think it's an end all for India. I mean, as in the valuations that are there, if anything, India will keep surprising the world, and probably the re-rating will keep happening. One saw the FIs coming back into the country, and that's what they saw appreciably, that look, US was looking much more deader than India was. And by the way, the money that has come in thus far in India is very active money. It is not the passive flows that India was seeing earlier. There's active money which has come in, active in the sense that it's not a ETF money which has come in. It's mainly the managers deciding that, look, I want to shift my money out of US or China or Taiwan and move into India. That's what the active money is all about. And I think that's a fairly good move, because this is what really moves the market. So I don't see, by the way, having said that, I also said that we are somewhere close to the peak valuations. Doesn't mean that we will correct the way we did earlier, right? The peak valuations, if anything, if the markets are not the markets, the fundamental support to that extent. And I said that probably next 2 quarters may not be that supportive for the markets. I don't see a big correction. I see probably a time correction happening. As I keep telling everybody, I think the market needs a breather, and probably a quarter or two of breather is what is will come through as such in the worst case scenario. So whenever a breather happens in the market, it's there'll be pockets which will do very well, and there'll be pockets which will do very badly. So the whole idea of an active fund manager is to identify those pockets which do very well, and hopefully we are good at that. So
that takes me to one question, which is, how do we balance the long-term conviction with this short-term market, volatility when, constructing the portfolio? So how are we trying to do that at this point of time? Because, there has been volatility. In fact, we also had, and our partners have also raised this concern that there has been one of the month, where we have not done well. Why? So that was a very volatile month. So, so how are we, looking at this, and on an overall basis, how are we managing this volatility while, still continuing with our long-term conviction on the ideas which form part of the portfolio?
So basically, Devi, that month was a very disappointing month for us also. But the fact is that our problem, I mean, rather I would say that it's our problem, as in because we are very early off the block. We always take a much earlier call. Not that we are contrarians, but I think we identify trends early, and that's when we get in early and we get singed, because those trends take a while to reel out, work out, and stuff like that. So maybe that is what has harmed us that point in time, but things are moving around after that. Secondly, again, as I was saying, that long term, our feel is that's a term invented to basically fool gullible investors. Long term for us is actually a series of short terms put together. And what I mean by that is that you keep testing your thesis on shorter terms. They add up to a long term. So suppose you like a particular theme that works out for, say, 3-4 months, right? After 3-4 months, you take a view again. Will it go further than this, or is it done and dusted? If it is yes, carry it forward for another 3-4 months. If you think it's going to go further, carry it forward for another 3-4. So that's those 3-4 months. When you put them together, if it's a long term, so be it. Otherwise, there's nothing like it. Fortunately, we've been very proactive in this whole call. I mean, if you, I'm sure most of the distributors will be doing that. If they see our portfolio, there are new names which come in and there are old names which go out, right, on a regular basis. There's never been a month when we haven't seen new names coming in per se, and new names as in 5-6 names in a month in a portfolio is fairly a healthy sign. In fact, the March month was a major month for us. We probably added some 30 odd names because of our mid-cap fund, but also they played a big part in our overall portfolio identification and stuff like that. So I think that's how one should be evaluating a portfolio. A manager who just continues to sit on his portfolio without churning, I don't think that's the manager you want to have at this point in time. But as I said, that the next couple of quarters are going to be very testing, and obviously you need proactive managers who can take that call that, look, this is done and dusted. I want to be out of this stock. Probably I'll buy this new one, which is looking far better than the old ones, and then work accordingly.
Then so there has been, so let's move on to these sectors, so you did mention about financials. Other than financials, where else do we see, sort of sanctity in terms of, investment thesis? While, we've been seeing, I mean, there are questions on defense and all that. Now, defense, what do you make of defense also? Like, it's up almost, the index is up almost about 25% or in a month's time, right? So is it like, still worthy looking at, or what are we thinking internally on that?
Basically, Devi, I think defense, apart from a few pockets within, I feel as it's like too frothy now. I mean, obviously, the whole thing came about because India gave a fairly, I think, a bloody nose to Pakistan, and all this was done through our indigenous technology, right? And that is what proved to the world that, look, we can even beat the Chinese, because Pakistan was all about Chinese technology, right? And the kind of warfare we did, we killed their drones, we killed their missiles, we killed the surveillance systems across various airports. I think that was a fairly big answer. I'm sure China will have a lot of questions on how we did that, but it showed the world the prowess of Indian manufacturing, Indian defense manufacturing. And that was a good sign. I mean, obviously, the world got up and said, look, we can have our shopping carts, I mean, rather the defense shopping carts built from India also, and at a very reasonable price, because India is fairly reasonable in that sense, right? So that's what I think happened, and that's why that massive move. But to an extent, I mean, when you see these kind of moves, you wonder whether future growth will even justify this. Most of the moves have happened in shipbuilders. Shipbuilders have limited capacities. They have only these docks, 10 docks, 12 docks, which they can fill, right? Beyond that, they cannot just manufacture ships just because we got orders, right? So, I mean, a couple of shipbuilders might know, I mean, order book of 30,000, 40,000 crores, and their revenues per month are per annum are 1,500, 1,600 crores. So it's obvious that they can't execute those orders and they're just remaining there. Mind you, if you guys remember BHEL, that was the same case with that. It's a matter of time before people get up and say, okay, fine. I mean, he's got the orders, but where's the execution, right? So that's what's going to happen in these cases. So I think it's overdone in certain pockets, but in certain pockets like electronics and all, the defense electronics, I think it's a fantastic play going forward, because electronics is one area where you don't need massive infusion of fixed assets to make those capacities, right? For shipbuilding, you need these docks, you need these massive manufacturing, I mean, machinery, the forming machines and stuff like that. Here you don't. You just need these CNC machines, which are perfectly placed and small blocks and stuff like that. So that's not a problem at all. I think that's what is exciting us more than anything else in the defense space. And we continue to own those stocks and such.
So, Anshup, before I move to some more questions there, a quick one. So, do you see the US, tariff hike as, a short-term geopolitical tactic to, sort of de-globalization? I mean, where do you see, I mean, what are we thinking about, this entire episode? That is this a risk India might face, where, India might get caught between this US and China thing, right? Because day before yesterday, earlier, there was a tariff which they have put in, and then, all of a sudden he changed his mind. So So how will markets, you think, will deal with these kind of everyday morning news, and how long will it react sort of in the way it is reacting, and what do you think of this?
So basically, Devi, I think it's here to stay. I don't think the US, the what they did, I mean, as in the tariff war that they've started, will get over so easy. I think they'll remain there. It is a matter of time before the world bows down to it. Right? All said and done, US is the biggest market. As Trump keeps saying that I'm the biggest buyer, so why not come and negotiate with me? And why should I be always listening to you guys? As such, yeah. So I think that's what is playing out here. So that tariff, but that those numbers were pretty out of proportion, like 26, 27% and stuff like that countrywide. China 140%. I don't think those are the numbers that one is looking at. I think across the board there'll be a 10% tariff. US will be happy that they won the battle, and the world will be happy that they negotiated down to 10%. So, but that still 10% is 3 times what US has today, right? Or rather had pre the tariff war started. 3.3 was, I think, the average tariff that US charged on the imports in, and now there'll be a 10, so it'll be a 3x thing. But understand the implications on the US. The fact is that I don't think the seller is going to absorb the tariff. It has to be absorbed even by the consumer. So there'll be ways of playing it around. Already Amazon and Walmart has said that, look, we'll put it up on the bill part, that this is what you had paid and this is how much the tariff impact is for you and stuff like that, and then you decide whether you want to go ahead with that or not. So that in fact will cause a inflationary pressure to go up. However, I mean, that's what the economists are stating out there, that with this 10% kind of tariff, it'll shave off roughly around a third of the US economic growth. So basically 50, 60 basis points will be shaved off because of this 10% tariff as such. If it was much higher, obviously that would have gone through the roof. So that's what's going to happen. And that's why I'm calling out a slowdown in the US. I'm not calling out a recession. I'm calling out a slowdown in the US. And I think one has to live with that going forward, at least till the time Trump is around. And mind you, he's got another 3.5 years to go. So it's a long way off.
There are a couple of questions on the power sector and infra sector, our outlook or our view on these sectors. So can you share our views on these sectors?
So basically, which power sector you're talking about, Devi?
Yeah, power.
Oh, so power sector, I think we are fairly bullish. But again, as I said, in pockets, we are bullish. We're not that getting carried away by the story that the power generators are going to do this and stuff like that. They need capacities also. So basically, if you see, our exposure to power is mainly by way of the suppliers, equipment suppliers, or very selectively the generators to an extent, or to the renewable guys as such. So I think that's what we are taking it forward with. And frankly, I mean, if the domestic demand picks up the way it is supposed to pick up, I think power will be a very big beneficiary going forward. Mainly because of the fact that the peak demand, I don't think the Indian generators will be able to manage those kind of supplies whenever the peak demand hits as such. So that way. And that's why we are very clear that power is one sector that you need to be in, need to be exposed. However, one has to be cognizant of the fact on valuation. So if you look at the private sector power generators, they're very overvalued. I don't think we are very comfortable. We are any way comfortable in owning those stocks. So you'll see those stocks not there in the portfolio as such. So that way. What are the other sector you were talking about, Devi? Sorry, I caught on to power.
Infra.
Infra again. So again, infra, our feel is, unfortunately, most of the infra players in India have to deal with either the state governments or with the central governments. Very limited amount of exposure to infra in our portfolio also. We do have some, but it's very limited in the sense that we try to get into only those spaces where we believe that they'll be more or less insulated from the the confusion that a state government brings into this whole play as such. So you'll see very limited amount of exposure here. And we've seen that in the past also. I mean, quite a few big groups have just evaporated because of the kind of patterns that have run up through the infra plays and all. So we'll be very selective out here. I don't think we're that overboard on infra today.
So what's our view on the gold and and silver?
So gold, actually, as I said that earlier, that gold is a perfect hedge in an uncertain world, right? Gold did very well when Trump was dilly-dallying. You guys remember when he said that 90-day reprieve, the gold went up. It didn't go down, gold prices. It was only later when he started negotiating deals that gold has come off. Right? So my feel is that once gold prices stabilize at whatever level, probably we'll again see, because Trump is very unpredictable. I mean, and as I said, gold is a hedge against unpredictability. So he'll be the biggest mover for gold as such. As and when he starts again dilly-dallying on things and stuff like that, you'll see gold again appreciating. So gold will be a steady asset to play, right? Silver being a derivative of gold, obviously silver will also be a very steady asset to play out with. But frankly, I think the biggest move in gold is done and dusted, because now things are looking much more stabler than what they were. Obviously, US will go through a kind of a small slowdown. You may see some inflation picking up, and you may see gold prices again picking up. But beyond that, I don't see gold to do too handsomely as such. If you had asked me last month or even before rather when the negotiation started, I would have told you that gold grudgingly will be a play for next 2 quarters, but it's fizzled out much faster than what it had done earlier.
So that brings me to another question, Dinsha, is this, that we have a decent exposure to financial services, and in fact financial services has also done well in last 2-3 months. So do we see that, and I think the index is also peaking sort of. So do we think that this will continue from here? And like in the past, it has happened that most of the time the onset of bull market, financials have led the that, right? I mean, so do you think that we are in sort of, we have gone through the downturn, India has gone through the downturn, and there's now upturn, which is the beginning of upturn, and it is going to be volatile, and people who will digest volatility will maybe come out with some kind of a returns in the next year or couple of years time?
So basically, Devi, let me take you back to history, because history is a very good teacher when it comes to the markets as such, because history repeats, right? So if one saw, so basically India, the call that we have is that India will probably be the 3rd largest economy very shortly. Right? We are the 5th largest today. We'll be 3rd largest probably by 27, 28 or so, not too far away, right? We're talking about calendar 27, 28. So basically fiscal 28, 29. Yeah. So if that is going to happen, the growth rate that you'll see will be somewhere in the vicinity of 7, 8 odd percent, 6.5, 7 odd percent. We're talking about real terms. Nominal is roughly around 11.5% kind of growth rates. Yeah. That is what probably US saw from the early 70s till the mid 80s. That's when they started depreciating dollar, by the way. That's when the US economy really picked up going forward. Probably Germany saw it in the early 90s. China saw it for a very prolonged period of, say, 2000, early 2000s till 2000, late 2010s as such. Yeah. For all these 3 cases, and these are very good examples, right? Germany is probably the 3rd largest. Even Japan saw it in the early 80s. Okay. The sector did very well was BFSI. And why it did very well in these growing economies was, by the way, I took the 3 examples because four examples, because all these 4 countries are the ones which are ahead of us in terms of GDP today. US, China, Japan, Germany, and India. Yeah, so that's how it is. So basically, these economies did well then. India is supposed to do now, and banking and BFSI sector did very well in this kind of period when they were rallying. Yeah, and why that was the case was because it was the domestic consumption and to an extent manufacturing which picked up and drove these economies on a rising spiral. Right. When consumption picks up, the banking sector has a double whammy or rather the banking and financial services sector has a double whammy. Why? Because one thing is that they need to fund this consumption. Right? As I said, when you buy a new house or a new car, you take a loan probably to do it. Large single tickets will not be moved out. Right? So that's what is one obvious way of capitalizing on consumption. Second way they capitalize is on offering loans for working capital to manufacturers, inventory loans to manufacturers, or even fixed assets for setting up fixed assets and stuff like that. So this is how the double whammy happens for the banking and financial services. In terms of insurance, obviously when your per capita incomes are moving up, that is the first place when you want to park. You want to look at safety, you look at your health insurance, you look at your life insurance, you look at your housing insurance and stuff like that. Yeah. So that's what picks up. So both general and life will pick up. And that's why we are so gung-ho on the BFSI part per se going forward. We have no doubt in our mind that this is a sector which will be a leader going forward. In fact, that's the only sectoral fund that we brought out. Unfortunately, it's not got too much of AUM, but I'm sure once the fancy picks up in the BFSI space, you'll see a lot of flows happening in that fund also going forward. So that's the way it is. And secondly, fortunately for us, for the past in fact, after COVID, the BFSI space didn't do much till a year back. And that's when the market started tanking and the BFSI started. I think that's what the leader position is. There's always a baton change at the top, and this is one of the changes that we have looked at.
And then, sure, and I think before we finish, one last question. Our view on, Fed and, what Fed would do maybe, and, also our view on the crude that, what is our view on the crude oil?
So basically, I think my feeling, in fact, I remember one of the anchors asked me jokingly that what will you advise Jerome Powell? And I said probably to find a new job because I get a feeling it's going to be very trying for him. One, the political pressure. And secondly, if there's some sanity within, he cannot increase rates. As I said, if US is going to go through a slowdown, the last thing he wants to do is jack up inflation by reducing rates, right? That will be a sheer sign of stagflation. And he's done that. He's done a fantastic job till now. He's held on to his conviction that I will not be increasing rates. I will not be reducing rates, and I will hold on to my rate cycle per se till the time he sees some growth kicking in. Probably that's when he'll start cutting the rates per se. But today, I don't think he'll be in a position to do that. So that's what it is. Secondly, on crude, I think it'll remain benign. I don't think crude will move up beyond that $64, $65 Brent I'm talking about to a barrel, mainly because of the fact that if US and China are going to go through a slowdown, there's no way crude can pick up. If 40% of the world is seeing a slowdown, 35-40% of the world, obviously crude will not be picking up, even though the 60% of the other part of the world is going to fire. But still, I don't think that's going to happen per se. So that way, yeah, nothing's going to happen. Move there.
And Desha, I think there are no more questions. Thank you very much for your time. Thank you, participants, for your time. With this, we come to an end of another session of Market Pe Charcha, and look forward to continued engagement and connecting with you next month. And our team shall get back to you on the date and time. Thank you very much for joining, and have a nice weekend. Thank you. Bye.
Thank you, guys. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.